What is going on, everybody? Steve here. I want to talk to you today about something. Uh, what's the difference between a stock investor and a stock trader? Now, a lot of people get the words mixed up, but it's a big difference in what it is and what both titles are used for. When I first started getting into, wanting to invest money and things like that, what happened was I didn't know which was which. I thought, like a lot of people think, oh, well, you get stocks in the stock market and you trade them. And I'm like, okay, to make more money. So I'm confusing a lot of what people call Forex, where you're trading dollar amounts and, different denominations. But I thought that it was like that with companies. But what happened was, this is what I learned. It's a big difference between a trader and an investor. So today I want to get into it. We'll start with the trader first. The trader is somebody that they look to make money fast, like really quick in short term. Like I give you an example. The movie The Pursuit of Happiness. You remember that with Will Smith? He was a stock trader. Like you seen all of the guys on Wall Street, the guys with the suits, the young guys that are executives, the people that are on the Wall Street floor, where all the paper's at, and you hear them ringing the bell. You see the people screaming with the paper and all that. Those are stock traders. It's very fast paced, and what they usually do, a stock trader, they rely on market volatility, like what the market's doing at the present moment. And what they do is they do short-term sales of stock. Like they might get up 2 hours before the market opens, and what you'll see them do is they'll have a bunch of shares of stock that they bought the day before. They might have got a tip in the news, or they might have heard something come down from the company through gossip from co-workers or other investors, because it's competitive. And they say, okay, well, I get to jump on this in the morning. So they'll buy several contracts, or a few contracts, which is 100 shares of stocks equal one contract. So they're trading hundreds of shares of stock the next morning. So what they do is they'll put their bids in. They'll put the bids in the morning, and then as the market opens and the curve starts, whether it goes up or down, they have to catch that right strike point, and they'll jump in on that trade and they'll watch it rise. And as it's rising, they're still adding stocks. And they're trying to make as much profit as they can before it dips. And then they'll jump out of it. And that's how they make their money. They rely on a fast and a furious approach. Everything is quick. Like if you ever watch some of these guys on YouTube that are stock traders, they'll say, you'll see the day in the life videos, and they'll say, oh, they get up in the morning and they'll show you live on their computer how they're making the trade. And you'll see them clicking, boom, boom, it's going up. They're clicking again, and then they'll jump out of it. That's how they make those thousands of dollars a day. Another thing is they take, they take advantage of price swings in the market. Same day, like we spoke about, and that's majority of how they make their money. Now, they don't focus on intrinsic value, which we'll get into in a second. What most investors focus on that are long-term investors. But this is what they do. They don't have to worry about where the price is going to be 10, 12, 13 months from now. They're only concerned about something they heard in the news, or they might get insider information. Oh, tomorrow their earnings are going to be, the rumor is they're going to beat smash their earnings. So they'll jump in and they'll boom, 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 knock it out. And they'll take their take and they leave. They don't care about the intrinsic value of the stock. They only care about the current price. They're often secretive about what they do, and that's I think goes along with the mystique of what when people see it. Of, oh, they say, oh, I would like to do that, you know, because day traders seem so cool, and, you know, they're on yachts, they got the expensive cars, they're driving in the Lamborghinis and stuff like that, and they, you know, come off of, you know, hey man, we're living a life. But I'm gonna tell you, they roll the dice on information that they get, and then they talk amongst themselves, and they're very secretive amongst themselves. Like a guy that's in a say, like I'm with a firm, Charles Schwab, and we on the floor, the sales floor, and you work for somebody else, T. Rowe Price, or you might be a trader for TD Ameritrade. I'm not going to tell you what I know about a tip I got about a stock, because I want the stock price to go down as low as I can so I can pull it and make the most profit and gain from it. So it's very very secretive, and of course it's so competitive, you know. Wolf of Wall Street, in the beginning of it, he was a stock trader, and you know, I don't know, you know, over time, you know, it doesn't really go into it. It goes more, it focuses more mainly on the characters, but in the movie, he accumulated a lot of stuff. Now it could have been from day trading, you know, which I may be wrong. I really don't know the situation like that. But my thing with this, and this is a warning, and you know, a lot of people don't know. If you ever seen World Series of Poker, right? And this is what makes this dangerous: if you don't know what you're talking about, if you don't know what you're doing. And a lot of people fall in this trap. New investors, they fall in this trap. I mean, new traders, and they say, oh, I want to trade stocks. If you have not had formal training, and these classes, I tried to go and do the classes. You know, these classes, they may be 3 or 4 weeks, and they might run 20 grand, and they want the money up front. Because they look at it like this: if you can't focus, if you don't have the money to do this, to get in it, because you got to have a lot of money. Just to open an account in most brokerage firms, you got to have 25 grand off the rip to even put it in there, so you can jump up and down this on this thing. Because a lot of day traders and traders, stock traders period, they rely on leveraging and borrowing money on the principle of making gains and paying it back. So it's kind of like doing it with your hair on fire. And you got to have a system and a plan. And that's why I would estimate thousands of people jump in this every year thinking they can do it, and they can't. And the reason why I brought up World Series of Poker, I can play poker, and I can play it on my phone all day and be real good and all this. But then when you get around real poker players that have been doing this a while, and they know what they're doing, you're going to be completely lost in this. And it's one of those things where you don't know the schooling these people have. You don't know what it is they have. You know, what people they know on the inside of companies that they're trading for. And they do that. They'll know people, hey, and they'll get these anonymous calls before they even start. And they keep it quiet. And they talk amongst themselves. And you know, they try to feel each other out. Hey man, what you trying to buy tomorrow? I don't know, man. What about this? And it might be the same stock that person, that trader, is thinking about. And he'll say, I don't think that's a good thing, even though he's thinking that it is, and he don't want the other person to know about it. So they do little tricks like that. But all in all, you know, people suggest when you first start off, learn about stocks, learn about what they are, how the market works, how the market, you know, moves. But I mean, I'm not discrediting something that I really don't know about. The surface stuff is what I'm just telling you about. But in my opinion, if you're starting out, if you want fast pace and all that, stock trading's free. A stock trader might be something you can deal with loss, and you got a lot of money. Stock trader may be for you. Now, we'll go back to stock investor. Now, a stock investor is different. It's not fast paced. It's low and it's slow. A lot of times it's boring. In a stock investor is more of long term, meaning you don't buy a stock and then trade it the same day with the idea of making a quick gain. This is a long marathon type, drawn out investment. That's why it's called an investment, where you put your money in for future gains later on in time. That's what I do. I'm a long-term dividend investor. Now, it's two types of investors. You have a passive investor, right? Which is more of like what I do, where I'll buy stock with the intention of holding it 2, 5, or most of the time when I buy stock, it'll be for 20, 30 years. Because I understand the intrinsic value of the stock, and whether it's high or low, I'm going to buy the stock if it's overpriced or underpriced, because with me doing that, I'm going to meet the happy medium, and it's going to average itself out over time. A long-term trader, right, will put his money into something, whether it goes up or down over time, whether it's a crisis or not, like how we're having a crisis now. For me, it's an excellent buying opportunity. Where people are panicking, I'm jumping in at the opportunity to build the positions, which is the quantity of stock I have. So where when we come out of this recession, I'll be out on top, and I'll be further ahead in my investment time-wise than I am now. As a passive investor, the reason why I call it boring is because you're buying stock, it's not much excitement in it, and you're looking for the return years down the line. So my portfolio, I won't look at it for 2, 3, 4 months. You know, unless I see something on TV and I'll say, hey, you know, reminds me of my stock. Let me go and take a look at it. And that's one of the things that's good about it. It's not stressful. You put the money in every 3 months or every month, depending on what stock you buy. It'll pay you your dividend, and it'll just add you and I get my dividend paid in stock. It's the price of my dividend paid in stock. So my shares are constantly going up, and it's a good feeling. You can rest easy. I'm building for my retirement, and it's just, all you do is sit back and chill. But as an active investor, we'll go to active investor real quick. Active investor is somebody that hires a professional to run their portfolio for them. Now me, I don't do that because I feel as though with the knowledge I have, I don't have to do that. And I don't feel comfortable, you know, not saying I'm a professional, but I'm enough. I don't feel comfortable having somebody tell me, hey, I think it's a stock you need to try, or this and that, because a lot of people, you know, don't want to deal with some people are lazy. A lot of people don't even want to deal with picking stocks. I don't want to deal with that. Let me just hire somebody else to do that. But the thing is, you got to pay them for doing that. You know, being a passive investor, you don't have to do that. I don't have to do that. I just focus on a couple of things. I learned a couple of things. Like, you know, let me see. I don't want to go on too much. Like, say earnings reports. All you do is, I learned earning reports, what earning reports are, balance sheets, income statements, financial reports of a specific company, and it's very easy to do. If you know what you're looking for, it's very easy to do. Reading 10Ks and stuff like that. I mean, it's just a little bit of reading, but it can go a long way with the gains you make, and you'll have a greater appreciation for the stock market and your gains. Active investors have a financial advisor. Passive investors don't. Also with active investors is, an active investor, when you put that on somebody else to do that for you, a lot of times, and this is just in my opinion, a lot of times you might lose out on your gains because you're paying them a certain amount of fee or a certain fee. And over time, them fees add up and you will get smoked. Like, say you started when you was 20 years old and you have an investor, you have a financial advisor because you have an active account. And he been with you, the longevity, y'all got a rapport, and you're like, oh, I trust this guy, I this, I that. And over time, you're paying these fees and all this other stuff for him to run your portfolio when you could have did it yourself. And at the end, you know, where it hits you certain, like halfway through your investment career, your investment experience, and you're like, man, and somebody comes to you and say, hey man, you know, you're getting ate up in fees. You might have lost $200,000 by the time you get done investing in fees for this guy. And you're not the only person. This man might run hundreds of people, you know? And it's pressure on him to make sure if you go and check your portfolio, you're making gains if the market's allowing it. So he wants to look good. And he has a pressure on him to look good or he'll lose his job with you. So he might pick and choose certain stocks and you might miss out on other things that if you understood the company profile and all these other things about the company, it could have been a good investment for you. You know, and with you following with the guy doing it, and then you say in your head, oh, I don't have to worry about it. I got a guy that watches my finance or a guy that picks my stocks for me. What if you see something that he doesn't, or something he doesn't agree with, and you have a really good idea about it, or feeling rather, and you miss out? But I mean, that's neither here nor there. An investor also is somebody that looks for the stock to appreciate. So like with me, I have a lot of shares of AT&T. I don't think AT&T is going to be going nowhere no time soon. I'll be off the planet before that happens. But it's a good company and it pays a very good dividend. And my shares just constantly flip. Every 3 months they flip. And I get more and more shares, more and more shares. And the value, my stock value goes up. You know, from that, that's just one of many positions I have. But it's a good feeling to know, okay, I started with this amount of money. And now it done raised itself. And the snowball, the dividend snowball is rolling. And the compound interest done kicked in. Man, it's a good feeling. Where you don't have to worry about nothing. And like, you know, barring, I don't want to say nothing crazy, the earth blowing up or anything like that. But it's just a good feeling. Another thing is, well, as being a investor, we look at it like we don't focus on price swings and this and that. When the market is bad, a lot of people jump out the market that have a financial advisor because they're scared. They see they see their portfolio is up, it's really up, and they're doing good. And they'll say, oh, well, I'm going to keep this money, and then they'll lose focus of the long run. And they'll call up there, sell, because they probably got $350,000 in their portfolio, and they're going to keep all that money. Because they're watching TV, they're watching other people saying, oh, well, you got to save money, you got to do this. We're in a recession, it's looking bad for America. And panic ensues. And a lot of people do that. They'll jump out the market. That's why it's fluctuating up and down now. You know, besides corporate investors or institutions, which are companies taking out massive shares at a time to make the market go up and down to cut their loss business-wise, you and me as an average person will see the market's red and be like, oh my God, everybody's selling. Well, I got to jump in and out. No. But I mean, it's just a little bit of what I'm going to say with a trader and a investor. Investor goes for the long run. You know, we welcome volatility with the movement, the swing movements, because when the stocks go down, they're on sale for us. We're buying them, and we're building our portfolio, and that's how wealth is built. Now, a stock trader, you know, is somebody is fast-paced. They want to get in, get out, make a couple dollars, and do it all over the next day. That's a big difference. One is more focused on the long term and is very slow growth, you know, with picking a good company that you see in the immediate future that's going to go forward and beyond with success to help your portfolio grow, where one is more fast paced and it's quick now money. That's the difference between the trader and the investor. And that's about it, guys. That's all I got today. I appreciate it if you if the information was helpful to you. I appreciate it if you smash that thumbs up button and hit the subscribe button. I appreciate it as usual. I enjoy talking to you. I upload videos every day, and I'm trying to get this YouTube train rolling. So I appreciate you sticking with me this far, and I'll see you soon. Thank you.